Hey guys, and welcome back to Mike and his whiteboard. My name is Mike, this is my whiteboard, and we're going to continue talking about liquidity today. So we're going to talk about another aspect of liquidity, which is the bid-ask spread. So we covered liquidity yesterday in the terms of open interest and volume, and how the numbers that we're looking for there can affect our trading decisions. But now we're going to dig a little bit deeper and talk about bid-ask spreads, which is really the difference between what the market is willing to sell me something for and what the market is willing to buy something from me for. So let's get into it, and we'll start discussing it with the bid-ask spread definition here. So essentially, the bid price is the price the market is willing to buy something from me for. So when we're talking about buying and selling options, we don't really know who we're buying and selling the options to or from. So we like to think of it as just a general market. So we know that the market is giving me prices for something that I can sell, and the market's giving me a price for something I can buy. So when we talk about the bid price, we're talking about the price that the market is willing to buy from me. So when I'm selling something or I'm selling an option, I know that the bid price is the price where I can sell it to the market. Now, on the other side, we're going to be talking about the ask price. So the ask price is the price that the market is willing to sell to me for. So when we're talking about an ask price, if the market is selling it to me, that's going to be meaning that I'm going to be buying from the market. So really quickly, when we're talking about debit trades, we're talking about the ask price being the natural price, because naturally when I'm buying something, the ask price is going to be the price I'm going to be looking at, because that's the price that the market is willing to sell me that contract for. And inversely, the bid price, if I'm looking to sell options, that's going to be something where the market's going to be buying from me. So when I'm selling an option, the market's going to buy that from me. So that's going to be the natural price for the bid price. So let's get into a couple examples here, and we'll discuss how this can be affected in certain trades. So when we're talking about debit trades, as we just discussed, we're looking at the ask price as the natural price. So you might see it in the DOE platform or the TOS platform. So the systems are smart enough to know that when we have a debit trade on and it shows you the natural price, you might also see it as just NAT for NAT. It's going to know whether you're buying or selling something, so it's going to show you that natural price. So if I have a debit trade, for example, a debit vertical spread, if I'm buying a call spread or buying a put spread, it's going to give me the ask price as my natural price. On the inverse side, if we look at buying a call, so we're going to give an example here of buying a call. So we've got a spread here of 5 cents. So you can see that if I'm buying a call, just a naked call, I know that I can buy that in the market for $145, and if I was looking to sell a call, I can sell it for $140. So when we're talking about the spread or the bid-ask spread, we're simply referring to the difference between these two bid and ask prices. So for this would be a 5 cent bid-ask spread. So because I can sell it at $140 or buy the option at $145, since there's that 5 cent difference there, that's going to be our bid-ask spread. So now let's look at credit trades. And credit trades are pretty much the same, but just a little bit different. So you take the debit trades, you flip it on its axis. So now the bid is going to be our natural price. So with credit trades, since we're talking about selling something, so if I'm selling a put spread or selling an iron condor or selling a strangle, anything where I'm looking to sell something for a credit, my natural price is going to be the bid price. So if we look at an example of this, we're going to look at selling a put spread. So we're going to look at a 3 cent wide bid-ask spread. So this is indicating that if I'm looking at selling a put spread for $3.14, and if I wanted to buy that put spread for $3.17, I've got a 3 cent difference between the bid and the ask. So I've got a very tight bid-ask spread of 3 cents. So what's really important to note is pretty much the difference between the bid and ask, and we want to have the tightest bid-ask spreads possible because that's going to give us the best chance for having a fair market price. So if we go to the next slide here, we can see a visualization of this. So we're looking at a 1 cent wide bid-ask spread. So the red we've got indicated for selling, and we've got the other option indicating for buying. So if I can sell something for 50 cents and buy it back in the market for 51 cents, this is pretty much the tightest spread that we can possibly have in the current market, where ticks are 1 cent wide with options. So you might see something like this in SPY, which is pretty much the most liquid underlying in terms of options. You'll see open interest and volume in the tens of thousands every single day. So this is going to be a very, very liquid product. And the reason this is liquid is because we have a lot of market participants. So we talked about yesterday how open interest and volume can give you a gauge for market participation. Well, the bid-ask spread is pretty much the result of that. So if I've got a ton of buyers on this side, so these bubbles are pretty much the frequency of action. So we're looking at transactions, we're looking at open interest. So the more activity there is on both of these sides, think about it as buyers and sellers being very active and being able to agree on a market price. So the more action there is on each side, as you can see here, it's going to push that bid and ask spread, or the difference between what I can sell something at and what I can buy something at. It's going to push that very tight together. And right here, we pretty much have a 1 cent wide bid-ask spread, which is the tightest possible for the option market. Now, if we look at something that's a little bit less liquid, so this would be an indication of a very wide bid-ask spread. So now, instead of selling the option with 1 cent difference between where I can sell it and buy it, now we're looking at a 30-cent difference. And you can see here, there's very little dots. So now we've got two people on each side that are actively participating in this market, which is pretty much why this spread is very wide. So since there's not a lot of activity, there's not a lot of participants that are able to agree upon a certain price, there's some people over here that think that this put should be worth 80 cents, and there's a couple people on the other side that think that the put should be worth 50 cents if they're selling it and 80 cents if we're buying it. So there's not a mutual agreement on the price, which is why the bid-ask spread is very wide. So the easiest way to think about this is, again, when we're looking up here, there's a ton of market participation. So when you look at something like SPY, where there's tens of thousands of contracts traded each day, lots of volume, lots of open interest, you're going to see a lot of agreements on this price, which is why we've got a 1 penny wide bid-ask spread. And you'll see that in the markets whenever you look at it. It'll be 1 or 2 cents wide usually for SPY. Now, on the other hand, if you look at something that is barely traded at all, so maybe there's 10 open interest contracts or 10 contracts that are traded that day that will give you the volume number. When we're looking at something that's much lower like that, you're going to see a pretty wide bid-ask spread. So there's not a lot of agreements. So the reason that this is very important is because if we were to take out the mid price, so basically the mid price is the difference between the bid and ask. So in this example, if we've got 50 here and 80 here, we've got a 30-cent wide spread. So the mid price would be 65 cents. So we just take the 30-cent wide, divide it by 2. Our mid price would be 65 cents. So there's 15 cents on each side. Now let's assume that we could not use that mid price for routing the order. So let's say that I went to go buy this put for 80 cents and I decided that I wanted to change my mind after 10 or 15 minutes. If I could only sell on the natural price of the 50 cents, I would essentially lose 30 cents. So out of the 80 cents I just paid, if I could only sell it back to the natural price of 50 cents, I would automatically lose 30 cents, which is almost 50% of the value of that option. Now, if we're looking at this example above, it's not going to be that big of a difference. If I end up buying this put and it's for 51 cents, if I want to sell it back for 50 cents, it's only a loss of 1 penny. So it's not going to affect me as drastically as this example would. So that's one reason we care so much about liquidity, just the fact that we pretty much have a locked-in loss here if we're dealing with just selling or buying on the natural prices, but also we might be locked into this position just because there's not a lot of people out there trading it. So if I were to get filled on something like this, so let's say I sold a put for 50 cents and I wanted to close it out, let's say maybe I was starting to see profits on that. If there's no one over here that's buying these options, then I'm not going to really be able to close it out. I might be locked into this trade just because there's such a huge lack of market participation. So that's another reason why we care so much about liquidity, and we really only stick with the highly liquid underlyings, which is why we were talking about those numbers yesterday. So for volume and open interest, we really want to see things that are above 1,000. And if we're talking about stock shares, we want to see things over 1 million. So 1 million shares traded per day for stocks, and over 1,000 open interest or over 1,000 volume per strike, whatever strike we're looking at. So that's going to give us a good indication of high liquidity, which is going to result in the tighter bid-ask spreads like this. So if we go to the next slide here, we're going to talk about these takeaways here. So essentially, liquidity is one of the most important things we look at. It's pretty much the king of all things in terms of options trading and being able to get in and out of positions at a fair market price. But in terms of bid-ask spread specifically, again, the bid is the price the market is willing to buy a trade from me at. So if I'm looking to sell an option, the bid price is going to be the lowest price because the market's willing to buy that from me. So if I want to sell to the market, it's usually going to be lower than if I were to buy from the market. So that's where that bid-ask differential comes into play. Ask is the price the market is willing to sell a trade to me for. So on the other side, if I wanted to buy something like a call spread or a put spread, as long as it's a debit trade, it's going to be the ask. So that's pretty much the price that the market is willing to sell me that trade or contract for. And mid price is the difference between bid and ask. So you'll see on the network a lot, we're going to be routing things for the mid price. For the Doe platform, actually everything is pretty much routed for the mid price unless you've changed your settings in the upper left corner. But naturally it's going to be routing things for the mid price because that's where we believe is the fair market value. So again, trading liquid underlyings is going to help us get that fair market value a lot easier. And tight bid-ask spreads are directly related to high levels of market participation. So just like we were talking about before yesterday with open interest and volume, essentially the more open interest and volume or the more activity we see in a particular strike price or just that underlying in general, it's going to give us a tighter bid-ask spread generally, and it's going to help us get that fair market price that we're looking for and be able to maneuver in and out of trades easily. So that concludes liquidity. So if you have any questions at all, please shoot me an email at support@doe.com or support.com, or you can tweet us at Doe Trading, at Doe Trader Mike. Thanks so much for tuning in. We're actually going to be off tomorrow, so we'll be back on Tuesday for another segment. Have a great weekend.
What's up, everyone? Thanks for watching our video.
If you like this video, give it a thumbs up or share it with a friend.
Click below to watch more videos, subscribe to our channel, or go to our website.